Believe it or not, after that whole scary market crash back in 2021, the S&P 500 has now almost recovered back to its all-time high, with Microsoft at all-time high after hiring ex-OpenAI's CEO. Apple is also at an all-time high. Tesla? Well, Tesla is not at an all-time high yet. You are now wondering, should you sell now, wait for the market to come back down, and buy back later? Or should you just continue to hold and continue to buy more? So, in this video, I'll be giving an update on what's going on in the market. Why is the market going up now? Will it continue to go up more? And more importantly, what should you do now? Before I start, do join my Telegram chat group t.me/Kelvin Invest to discuss stocks, personal finance, and more. 2023 started out as an amazing year. Not only did the market stop crashing late last year, it also turned into a bull market as it recovered most of its losses and gained an incredible 27% from its bottom. But then, in July, the market kind of peaked and started coming back down. This sell-off was due to a number of reasons, such as the fear of a weakening economy, uncertainties about the future monetary policy, and the rise of geopolitical tensions. Then, in late October, the market suddenly stopped falling and started coming back up. In fact, it was the quickest comeback in 50 years. However, what's interesting is also the fact that while the S&P 500 had been performing really well, most of the returns actually came from just the 7 largest stocks in the S&P 500, or also known as the Magnificent 7, such as Alphabet, Amazon, Apple, and yes, Tesla. If we check the S&P 500 Equal Weight Index, which gives each company the same weight regardless of its size, its year-to-date performance is only 3%. Meanwhile, the yield curve is still inverted, which signifies that a recession may come soon. So, I guess the question is, where will the market go from here? The first thing we could look at is historical trends. According to LPL, the market tends to give the highest average return in the fourth quarter. But what are the chances of this happening? Bloomberg found that if the market gave more than 10% in the first half of the year, there's an 82% chance that it will also give a positive return in the second half of the year. So if we look at the S&P 500 chart, it seems like this is slowly starting to come true. Historical trends aside, how about the geopolitical tensions in the Middle East? Would it have any effect on the stock market? Luckily, not much. Unlike the Russia-Ukraine war, which caused energy prices and food prices to go up and the market to crash, the events in the Middle East has so far mainly affected the price of oil. Though, this is still pretty tame as compared to some of oil's historical highs. As a result, this should only have a limited effect on the market. Also, historically, the market has on average given positive returns during times of geopolitical crisis. Check this out. We could see positive returns as early as the 3rd month, and after 1 year, it has given an average return of 12.3%. However, it may be still too early to tell what may happen, as the situation could go either way. Next, while the war may not have much effect on the market, what's more likely to affect the market is the federal funds rate, because higher rates lead to higher costs of borrowing and lower spending, which in turn affect companies' earnings. The interest rate is now sitting at the 5.25% to 5.5% range. While the Fed previously signaled that they might raise rates one more time this year, everyone be like, I don't believe you. Instead, they are now expecting the Fed to stop raising rates altogether and keep it there all the way until March next year, after which the rates are expected to start coming back down. As for whether this will come true or not, it will largely depend on how long inflation will stay high for. So far, inflation has been slowly coming down steady from PP and is now sitting at 3.2%. Though, this is still quite far from the Fed's target of 2%. Which is why the Fed has once again reiterated that the inflation is still too high and they might have to keep rates higher for longer than expected. But how will high interest rates affect the S&P 500? As expected, the S&P 500 revenue per share as well as the earnings per share has been declining. Even Elon Musk has been KB about the bad economy. Though, not all sectors are equally affected. Some will do better than others. For example, communication services, consumer discretionary, and the financial sector have given really good earnings growth so far. While on the other hand, healthcare, materials, and the energy sectors be like, I don't feel so good. However, despite all the doom and gloom, analysts are expecting companies to have a strong earnings growth of 11.6% and revenue growth of 5.4% next year, as opposed to 2023, where the S&P 500 will only have an earnings growth of just 0.6% and revenue growth of 2.3%. This is quite in line with historical data, where it was found that the longer time from the first hike, the better the market will perform. Besides that, in a recent Reuters poll, according to a median forecast of 33 strategies, the S&P 500 could finish next year at 4,700, which is 3% higher from the current level. Quick pause. With UOBAM Invest, you'll be able to invest in a globally diversified portfolio that's carefully designed by a team of investment experts. At the same time, because each of our financial goals, risk tolerance, and investment horizon are different, UOBAM Invest has something called a glide path solution, where it will aim to maximize your returns by shifting the allocation from higher risk assets to safer ones systematically and gradually towards the end of your chosen investment period. What's nice is that with UOBAM Invest, you are able to invest with as little as $1 or enjoying a low annual fee of anywhere between 0.6% to 0.8% per annum. Or if you are someone who's looking to diversify your portfolio with a do-it-yourself approach, you can also check out Fund Direct, which allows you to customize your portfolio from a range of curated funds, or the Megatrends portfolio, which lets you invest in thematic trends that are shaping the future of Asia. As a bonus, if you sign up using my link down below, you'll get to receive a $10 credit. Terms and conditions apply, of course. And with that being said, let's get back to the video.
But then, what about the recession? Will it happen?
Because if we look at history, the S&P 500 has on average dropped by more than 20%. For this, there are two data that we can look at. First, almost every time that the Fed raises rates quickly, a recession will come after that. And two, whenever the yield curve inverts and uninverts itself, a recession will also follow. So does this mean that if you add both up, a recession will definitely happen and the stock market will confirm crash? Maybe. However, it's still worth noting that just because this have happened in the past doesn't mean that they may happen in the future. It's like how when my Chai Fan auntie used to call me Striker in the past has since stopped calling me Striker. A good example of this is in 2019. After a yield curve inversion happened, a recession did come in 2020. But if you think about it, how did it even predict that the pandemic would happen and crash the global economy unless the Illuminati? And even if a yield curve inversion can accurately predict a recession, it can take anywhere from 10 months all the way to 4 years for a recession to happen, during which anything could have happened. The market could either go up by a lot or crash by a lot. So it's a pretty unreliable indicator to determine where the market will go in the short term. So what should you do now? Let's break this up to when will you need the money. If you need the money in the short term, the answer would be pretty straightforward. You can just park your money into high-yield savings accounts, bonds, fixed deposits, or even money market funds, all of which will easily give you 3 to 4% return.
But then, what about the long term?
Obviously, we have all seen charts showing that stocks will beat bonds and cash over the long term, and that the longer you hold your stocks, the higher your chances of making money. For example, if you just hold the S&P 500 for just a year, your portfolio could either give you a positive 52% return to as low as negative 43% return. Hold it for 3 years, you could either get a positive 30% return to as low as negative 27% return. But if you manage to hold for 20 years or more, there's a 0% chance of getting a negative return. Historically speaking, of course. This makes a lot of sense, since as the economy progresses and companies make more and more money, the market will tend to go up over time. So then, is this a good time to be investing? Or should we wait for a while for things to get better first? What makes this so interesting is that right now, bond yields are rather high now. So should we be investing into bonds to get a guaranteed return of 4 to 5%? Or invest into stocks which could either give you a positive return or make you lose money? Peter Lynch, one of the greatest investors of all time, said this: "I didn't buy bonds for defensive purposes just because I was afraid of stocks. I bought them because the yield exceeded the returns one could normally get from stocks." And his advice is to sell stocks and buy bonds when yields on long-term government bonds exceed the dividend yield of the S&P 500 by 6% or more. Right now, with the 10-year Treasury yield sitting at 4.4% and the S&P 500 dividend yield is at 1.52%, it is definitely still not the time to sell your stocks and buy bonds. For that to happen, the treasury yield needs to reach 7.52%, which would be incredible. At the same time, the S&P 500 forward 12-month PE ratio is currently at 18.6, right between the 5-year average and the 10-year average. This means that the S&P 500 right now is neither overvalued nor undervalued. That's why, for me personally, I will still continue the dollar cost average into the stock market. Market up, I buy. Market down, I cry a bit, then I buy more. Because let's face it, unless you are good at reading charts and better than all the economists who are bad at predicting recessions, chances are you will never be able to buy at a perfect price. Though, a tip is to keep some spare cash on the side so that if the market ever crashes hard, you can then buy in at a fantastic valuation. Anyway, that's all for this video. Hopefully, you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.